Private credit has become the hottest asset class on the planet, dominating discussions in high finance and reaching dizzying heights of nearly $2 trillion in assets. But what if I told you when you actually dig into the data and loan documents, you find a completely different picture? Phantom income, Ponzi-style loans, and zombie companies keeping the industry alive on paper while the real money slowly bleeds out. I'm Boardroom Wire, let's jump into it. So first off, why do we even care? Why is private credit the hottest trade on Wall Street? Simply put, after the 2008 financial crisis, banks stopped lending to risky companies because regulations got tight. Private credit funds stepped in to fill that void. They aren't banks, they're investment funds that lend money directly to the companies. For the last decade, this was the perfect trade for a few main reasons. The first was speed. Private credit firms weren't bogged down in the bureaucracy of regular banks, there was less due diligence, and therefore you could close deals in weeks, not months, that it might take with a legacy bank. The second is returns. These private credit investments offered massive yields, often upwards of 10 to 12%, because these loans had floating rates and because private credit, being unregulated, also has the flexibility to create more creative financing structures. This floating rate nature of these loans as well also meant that as the Fed raised interest rates, these lenders actually made more money and had the perfect hedge against a rising rate environment. The third is demand. So regular investors are not the ones driving and fueling this private credit craze. It's actually institutional investors like insurance firms and pension plans that are committing all of this capital to private credit. And the reason for that is it's a perfect marriage with their existing businesses. The illiquidity of private credit coupled with its high income feature make private credit firms and insurance and pension plans and other institutional investors a perfect marriage. All of this led to the $2 trillion golden era in private credit. But in 2025, those high rates that made the lenders rich are crushing the borrowers. And that's where the engineering behind all this really begins. The first pillar of the silent crisis in private credit is PIK, which stands for payment in kind. In a normal loan, you pay interest in cash, but when a company runs out of cash, private credit lenders have a choice. Either force them into bankruptcy, which obviously looks bad, or flip on a PIK toggle. PIK lets the borrower pay interest with more debt. They don't send you any cash, they just add the interest for that respective period to the loan balance. The lender books this as income even though they received $0, and the borrower stays alive and lives to see another day. Now, there's a couple problems with this. The first is that these firms are essentially kicking the can down the road with these borrowers and hoping that things figure themselves out along the way. Think of this like technical debt in a software business. You're ignoring the bugs today to continue shipping the product. And while it works for a while, eventually the code base becomes unmaintainable and you're going to have a problem on your hands. Now, the second issue is more structural, related to how these credit firms actually run their business. Like I mentioned, much of this income in PIK is not yielding any cash. However, firms that are raising capital through things like BDCs or business development companies are required to distribute 90% of all of their income each period to maintain a certain tax advantage status. Now, what happens when the borrowers aren't actually paying you any cash? How do you distribute this to your investors? Well, this forces you to essentially drain your own reserves to pay the tax man or borrow against it. If PIK is how we hide the problem at the company level, NAV loans are how we hide it at the fund level. Like we discussed, funds need to distribute capital to their investors. When there's no cash income because you're picking the whole loan, NAV financing provides that liquidity. NAV stands for net asset value. NAV loans essentially allow you to borrow money against the total value of your fund or companies. So as borrowers pick their loans, aka borrow more money, the value of the credit manager's funds are increasing since there's a larger debt position with those respective companies. This creates a three-part circular flow. One, a fund has a portfolio that's picking loans and doesn't have a lot of cash income. Two, the fund takes out a massive loan against either the company or the entire portfolio to have cash on hand. And then three, they take that borrowed cash and send that to their investors as a distribution or potentially make even more investments. NAV lending essentially allows funds to lever up their loans, which is a relatively normal practice, but raises eyebrows when loans are picking and not actually producing income. It's a lot like taking out a second mortgage on your home. However, what's tricky about these assets is they're not quite as easy to value as a single-family home. The third leg to this stool is the valuation black box within private markets and private credit specifically. Because private credit is a level 3 asset, it basically means that it's not liquid enough to have a consistent valuation on an open market. Unlike a stock that has price ticking every second, private loans are valued by the fund managers and third parties in an extremely subjective manner. Managers argue that because they hold loans to maturity, the day-to-day price doesn't really matter. But this creates a reality distortion field. You can have two different funds holding the exact same loan, and one marks it at 95 cents while the other marks it at 70 cents. Same borrower, same loan, completely different prices. This creates a serious challenge when you're trying to evaluate the credit quality across all these funds. When you have loans that begin picking, some in the junior tranches of the facilities up to 97%, you really don't know if those loans are going to pay off at the end, and you essentially have these zombie companies that are staying alive off of all of this cashless debt that they have. They're generating enough cash to keep the lights on, but you never really know if they're going to be able to pay off the principal at the end of the loan and could be just walking dead. Now, the big question that people are asking is this the next global financial crisis? Is this another 2008? And despite everything I've told you so far, the answer is no. Here's why. 2008 was a liquidity crisis. It was essentially a run on the bank with fire sales of risky assets and withdrawals creating serious pressure on the financial system. The difference with private credit is it's largely a closed system that operates in closed-ended funds. This basically means the investors, the pension funds, the endowments, the insurance firms, have their money locked up for 7 to 10 years. They can't just pull their money out at their leisure. They're essentially in it for the long haul. This means that we aren't facing a collapse, but we could be facing a slow bleed. Instead of an explosion, we could just see a decade of dragging returns. The golden era of 12% yields might erode as some of these PIK mountains finally crumble, and it could underperform relative to what we've seen the last 10 or 15 years. So while it's not another 2008, the risk hasn't been eliminated. It's just been hidden in the footnotes, pushed into the future, and paid for with more debt. With that, we'll wrap things up. If you enjoyed this video, please like and subscribe. I'm Boardroom Wire. See you on the next one.